option traders. For today's trade, we're looking at a neutral option play in FedEx, the global provider of shipping, transportation, and business services. The stock has been drifting higher over the past few months after gapping down over 21% on September 16th. That day, the shipper released negative outlook for its fiscal 2023 earnings, which came amid investor anxiety that the U.S. may be headed for a recession in 2023. Shares have since regained support at their 21-day and 50-day moving averages, but remain below the 200-day line. Next week, on Tuesday, the company is expected to report earnings after the close, which has injected some volatility into the option prices. Based on this, we're looking to put on an iron condor trade in the stock to take advantage of the inflated premiums. An iron condor is a risk-defined strategy, which means that you know your maximum loss potential ahead of time, and it's not unlimited. The strategy is made up of two credit spreads. You have a bull put credit spread and a bear call credit spread. So remember, with options, there are two types of options. You have calls and puts. With both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy it long or sell it short. Both bear call credit spreads and bull put credit spreads are made up of one short option and one long option. Both credit spreads allow the seller to collect a premium upfront for initiating the trade. For the iron condor, we are putting on both a call credit spread and a put credit spread at the same time. Again, each spread is made up of two option contracts. So that's 4 option contracts total in the iron condor. This is a great way to get exposure to a stock without taking directional risk. Iron condors are neutral trades where the underlying assumption is that the stock will not move in either direction, up or down, to any large extent before the expiration of the trade. Iron condors serve to take advantage of a volatility contraction in a given stock. For example, like when a stock is going into earnings. Put simply, this trade is ideal to use when an underlying stock has higher than normal volatility. These strategies benefit from the passage of time and any decreases in implied volatility. By combining a bull put credit spread and a bear call credit spread, they create a spread of spreads, that is the iron condor. Both the calls and puts are all on the same underlying stock and have the same expiration date. But each leg of the trade has a different strike price, and that creates this range. The distance between the strike prices for both the bear call spread and the bull put spread should be the same. That symmetry keeps the trade non-directional. The investor can expect a profit or a loss on the iron condor based on where the stock finishes within that range upon the option expiration date. So let's take a look at my trading platform and set up a trade together.
So here we are on thinkorswim. And first, you're going to use ticker symbol FDX for this. Make sure you are on the December 23rd expiration date. You've got your strike prices in the middle, and really you can select any one of them for on thinkorswim here, but I've selected this one and adjusted the specific strikes down below. So to set this up, we are looking to sell one 192.5 call, buy one 197.5 call, sell one 162.5 put, and buy one 157.5 put.
Using the December 23rd expiration, we could sell the 162.50 put and buy the 157.50 put. This creates the put credit spread. Then to create the call credit spread, we're going to sell the 192.50 call and buy the 197.50 call. In total, this iron condor will generate around $1.30 per contract, or $130 of premium. The profit zone ranges between 161.20 and 193.80. This can be calculated by taking the short strikes and adding or subtracting the premium received. As both spreads are $5 wide, the maximum risk in the trade is $370. If we take the premium divided by the maximum risk, this iron condor trade has the potential to return 35%. If price action stabilizes in the stock, then this iron condor will pay off. But if FDX makes a bigger than expected move, the trade will suffer losses. Remember that trades held over earnings allow for very little room for adjusting, so they can be pretty hit or miss. But FDX has stayed within its expected range for the last 4 out of 5 earnings releases. Although we know past performance doesn't guarantee future performance, these patterns do help us weigh in on this decision. As always, remember that if you're new to options, make sure that you practice with a virtual account before risking any real capital. And remember that options are complex and investors can lose 100% or more of their investment. Check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.